On this episode of China Unscripted, a lot of American investors have money in the China market, but investing in an unfree country comes with risks, much bigger risks than most people realize. Welcome to China Unscripted. I'm Chris Chappell.
I'm Shelley Zhang.
And I'm Matt Gnezda.
Joining us today is Perth Tolle, founder of Life and Liberty Indexes, which makes human rights and economic freedom the bottom line of investments instead of just the bottom line. Thanks for being here.
Thank you so much for having me.
So your company runs the Freedom 100 Emerging Markets Index, which you describe as a freedom-weighted emerging markets equity index. So first off, what is freedom weighting? I mean, I know America has an obesity epidemic, but I've been working on that all night.
Yeah, so by weighting, we just mean the way that we allocate to the stocks in the portfolio. So, and in this case, the countries in the portfolio as well. So we're taking a top-down, country-level freedom weighting approach. So in indexing and in ETFs, which is the type of product that we operate, the default weighting mechanism, or the way to choose securities and weightings in securities and in countries, is by market capitalization, which means the biggest market in any particular category, in this case emerging markets, gets the highest weight. So in most emerging markets investment indexes, China has about 40% weight in that overall index. In emerging markets, broad-based type of investing.
So that would mean more money goes to China in this kind of investing?
Yeah. So if you invest $100, $40 goes to China, and then the rest goes to other emerging markets. There's 26 emerging market countries by most standards, depending on whether you're looking at MSCI or FTSE, who basically are the two that set the standards because they're the biggest benchmarks and indexes. So that's a lot to any one country, regardless of the country, but especially China, because there's a lot of geopolitical risk in that country as well. It's a very unfree market, which has its own set of special risks. So what we do is we freedom weight. So instead of looking at the capitalization or the size of the country or the securities, we just look at which countries have higher freedom levels, and we define freedom as the rights to life, liberty, and property. So personal and economic freedoms. And we use quantitative data. So it's all objective. It's all third-party data from the Cato Institute, the Fraser Institute, and the Friedrich Naumann Foundation in Germany. And so they look at 76 different metrics on the country level of these types of freedoms, of personal and economic freedoms, from everything from terrorism, trafficking, disappearances, internal organized conflict, women's rights. Things like missing women is a proxy. So in China, as you know, there's 30 million missing women by official estimates. So that's one of the metrics out of the 76. And then there's, rule of law, due process, freedom of speech, freedom of media, freedom of expression, freedom of assembly. There's economic freedom metrics like sound monetary policy, free trade policies, business regulations, taxation, and so forth. So they take all of those metrics together, and I take the composite score. I don't pick or choose any particular metrics over others, just to keep third-party objectivity. So I operate completely independently from those guys, and they operate completely independently from us. So there's no way I could influence their scoring in any way. And I just use that score to derive, based on our proprietary methodology, the country weights and selections. So as a result of freedom weighting, we don't arbitrarily exclude any country. But as a natural result of freedom weighting, there's no China in the index. There's no Russia, Saudi Arabia, Egypt, or Turkey.
In a way, it seems like it makes a lot more sense than weighting it by market capitalization, which kind of seems arbitrary and I don't even know why that would have an impact on risk or return on investment,
right?
If you rate it by market cap. But that's just how everyone does it, right?
It is. It's just the way it's done. And that's because I think indexing is meant to be like a good representation of the whole market. So they just take, whatever markets has a bigger representation, we just take a bigger piece of it. But that which works great in developed markets. So developed markets being the bigger, more free markets. There's not a lot of, it's very homogenized as far as freedom levels. There's not a lot of, discrepancies in freedom levels. So, and there's not a lot of these risks that you see in emerging markets. So in developed markets, that kind of makes more sense. But in emerging markets, I completely agree with you that it doesn't make sense at all to do it that way. And in fact, freedom lays the foundations for economic growth. And so it's if you look at history, the freer markets have always been more dynamic and have had more sustainable growth versus like debt-driven growth or kind of the more unsustainable types of kind of like a fake economy, that we are seeing in some of these emerging markets now.
So some of the arguments to be made for why people invest in emerging markets indexes is because they want the more risk as like because it could mean more return, or they want the volatility because they think it could make greater returns. Does freedom weighting change how like useful it is to invest in emerging markets?
Yeah, so freedom weighting, the way we do it is it doesn't change the risk characteristics significantly. It's actually a little more concentrated just because we take the 10 largest, most liquid securities within each of our included markets, excluding state-owned enterprises, just to take the economic freedom theme all the way through. But because we take only the top 10 in each market, it's got less securities overall. It's got 100 securities, so 10 countries, 10 securities. And so that's why it's a little more actually concentrated than what you see as far as the other emerging markets index funds out there in the ETF world, which are like EEM, IEMG, and BWO. Those have, thousands of securities. So it's actually a little more, I would say it's a little higher risk, but it's not significantly. So if you look at the kind of the risk measures, they're all pretty similar, with our products being a little higher.
Wait, so how are the freedom and liberty indexes higher risk if the whole point of trying to do it this way is to lower the risk?
Yeah. So when I say higher risk, I mean it's more concentrated. So there's more ups and downs. But if you look at the overall, it's going to be very similar to tracking the MSCI benchmark.
It seems like everyone wants to invest in China. So I imagine it's pretty shocking to people to hear that you run an index that does not invest in China.
Yeah, so that has been the case historically, but recently we've seen a lot more uptick in interest. So as you can imagine,
I wonder why.
Yeah, all of these things that you guys have covered, and you know all about China, but I think most people have been in the U.S. at least have been pretty myopic to it, or a little bit blind to what goes on over there. We are pretty naive when it comes to dealing with China, and we are, and other, kind of countries, but especially China, because we see them as this, place where there was, miraculous growth over the last 30 years. And what happened there is basically they had abysmal policies under Mao, and, millions of people basically died under those policies. And then they opened up a little bit. So they liberalized their economic freedoms a little bit. And, now their policies are not terrible. So they went from abysmal to not bad. And that created this illusion of an economic miracle, a lot of which was debt driven. And they're still experiencing some reverse progress. So they're going backwards on the personal freedom side, even as they've liberalized on the economic freedom side, in which that side has stopped opening up as well. So all the freedoms, they have to work together. It's like the parts of an automobile. You can't have a transmission without a steering wheel. Still not going to go. So without the
You've never seen my car.
So without the without the personal freedom side, without matching the progress that they've made on the economic freedom side, on the personal freedom side, they reached kind of a plateau, and we see it now. But, Americans, we've enjoyed high freedoms in this country. And yeah, there are, and I realize that has not been very equal, and that there are diversity issues, and that those are and we're seeing that kind of boil over at this point, which I think is very healthy. In America, we have freedom of assembly and freedom of speech and freedom of media. And we've seen some erosion of that, just a tiny bit. But
we're not China, is what you're saying.
Exactly. So in countries where we have these freedoms, we have the means to kind of peacefully correct injustices. Whereas in countries that don't have these freedoms, as you're seeing in China, and you see the people of Hong Kong, the people of Xinjiang, obviously Xinjiang can't do anything. Hong Kong being the freest place in China, they've been able to use some of the freedoms they've enjoyed in the past, and they're going to fight to the end, and they've given everything. The Hong Kong people have given everything to fight for these freedoms, but you can see still that it's still not as effective. They've been, out on the streets for a year asking for an independent inquiry into the police brutality, and they haven't gotten it. And in fact, the police is getting more forceful, more powerful. So, whereas here, we've been protesting for several weeks, and we have gotten some results already. So it's a huge difference, and that's why people that are living under the oppressive regimes can't really do all that much for their own freedoms. So people like us who have freedom, it really depends on us to stand up for people who don't.
So the Chinese Communist Party claims that they are maintaining stability in society, and investors typically want to see stability in a market. And so what's the economic argument that, it's not just economic freedoms, but what's the economic argument that personal freedoms, that more personal freedom is actually better for market growth or market stability?
Yeah, so countries that have more personal freedoms, which goes along with the economic freedoms as a whole, human freedoms as a whole, basically they have more sustainable growth. They recover faster from drawdowns, and we'll hopefully see that going forward because they're more innovative and more flexible to react to market trends. And they use their capital and labor more efficiently, so they have less capital flight and capital distractions. So you see a lot of people. So let's just take China as an example, being the the big elephant in the room here, because of emerging markets has such a huge weight to China. If you invested in China in the last 10 years, if you look at the Shanghai Composite Index, for example, you basically got no returns, basically flat. But as we know, China had huge growth over the last 10 years. So where did that growth go if not to investors? So when you're investing in a very unfree market, with a lot of state control, a lot of that growth, or that the money that you invest, and which should be growing, and there's no shareholder protections, it actually is going to they siphon it off to state actors or who they want it to go to. So when you're investing in an unfree market, you're not getting that return as you would in a free market. So that actually is one of the main reasons for investing in the freer markets. You mentioned, hey, why does it seem more risky? Well, I'm just looking at the standard deviation as a metric of risk, and that it's slightly higher in the freedom product, but that varies day to day. Some days it's lower. So and that's because of the concentration of is more focused on 100 stocks. But you're right in saying that it's much more risky to invest in an unfree market. So for example, we've seen with Luckin Coffee, right, that there's non-transparency risk, there's fraud risk. China actually has a law that you cannot disclose, like, your audits for your public companies are state secrets. So you cannot disclose them to outsiders. You can't disclose them to foreign investors. And then the SEC in the US has a law that you have to be transparent with your audits, and you have to let us go in and audit you. So by Chinese law, these Chinese companies that list in the US cannot abide by US laws. So there's a contradiction there. And in China, when you invest, not only do you not get a lot of the returns get siphoned off to not the shareholders, but state actors. There's also the risk of just complete state control. So for example, there was a company called, a Wall Street Journal.cn. This is something that a friend of mine invested in a couple years ago. And what they did is they translated the Wall Street Journal into Chinese for the Chinese consumer in China. And this stock did extremely well. And then one day, the Wall Street Journal had an article that criticized the Chinese government, and it was translated into Chinese. Immediately, the site was shut down and the stock went to zero. So you have that risk of investing in unfree markets as well, as that your company could completely disappear in one day if you displease somebody in the state.
Oh, like Anbang Insurance just completely collapsed.
Yeah.
Yeah.
Well, can you talk a bit about Luckin Coffee and sort of how that all went down and then what that has to do with the way that you guys invest?
Yeah. So for listeners who may not be familiar with Luckin Coffee, this was a coffee chain in China that was supposed to be the next Starbucks. So that's how they sold it to foreign investors, especially U.S. investors, and saying this is the next Starbucks in China. And in China, they were giving away free coffee. It's basically like an automated coffee shop, right? So, and it turns out that they had basically. So they IPO'd in the U.S. and the stock went up, and they basically had made up all of their sales numbers to the tune of millions, tens of millions. So it was, I don't remember the exact number, but it was a huge number that was just basically made up. And now more news has come out that they've made up employees as well as they're making up a lot of things that are just complete fabrications. When this was revealed, the stock plummeted like 70-something% in the same day. They halted trading. It was trading here in the U.S. And on that day, I looked up. I was like, who are the biggest shareholders of Luckin here in the U.S.? And I was, in the ETF world, and I was expecting to find it to be the China funds, but it wasn't the China funds. It was these broad emerging markets funds, IEMG, EEM, and VWO. They were the biggest shareholders of Luckin Coffee the day that all this news hit the fan. So that's the power of these emerging markets funds and how much money is in them, because most investors, most professional investors will have an allocation to emerging markets. They may not have a specific allocation dedicated to China, but they will have an allocation to emerging markets. It's pretty, well established that emerging markets is part of an overall allocation. So most people will have an emerging markets, product in their overall strategy. How much you have depends on the risk tolerance, the risk profile of the client, but it's a part of the whole that is, part of the pie.
Could you give us an idea of how much the range would be?
Yeah. So what I see with clients is it's anywhere between 5 and 20%, depending on the risk profile of the client. So, but it could be anything. So it depends on a lot of different factors, client preferences mostly, and what's appropriate for them. And most advisors will help people determine this, or the big institutions, they have their policy statements that will determine that. So every pension in the United States, every, like for example, a TSP plan, TSP actually doesn't have a specific sliver to emerging markets. And the controversy you saw with them was more the all world index and which one to use, which includes emerging markets. So it's definitely a part of most investment portfolios. And so you're going to be very hard pressed to find someone who is in a well-diversified portfolio that doesn't have emerging markets. I see that more often here in Texas, but it's very rare elsewhere. So that's how much money is in these emerging markets. And so the people that set the benchmarks, that set the standards, like MSCI and FTSE, have a huge responsibility to make sure that these the way that people are investing, that they're aware, first of all, of the risks. And also just to make sure that, some of these countries are not so overweight. But because of market capitalization weighting being the standard, they can say, well, there's nothing we can do. We're just indexers. We don't really tell people how to invest, but I would argue that you do. You have huge power and responsibility as an indexer to set the standards and tell people exactly how to invest, because 95% of the world's institutions are benchmarking to your index, which means they cannot deviate from what you have by more than a few percent. So if you have 40% in China, they can't have less than 35% in China based on their policy statements. So I think indexers, that's why I wanted to create this, is for people who want an alternative so they can have, emerging markets exposure without investing in, autocratic regimes.
Well, so you used to be a private wealth advisor at Fidelity Investments. What was the moment where you decided to leave that and, found Life and Liberty Indexes?
Yeah, so I think this actually, I grew up in both China and the U.S. So after college, I lived in Hong Kong for about a year. And that's where I first realized what an impact freedom made, not only in my life, but also in the markets in these different places that I've seen, the U.S., China versus Hong Kong, and there's just difference in those markets. And I saw that, at the time, it was like 2003. There was a lot of excitement about the China business. It was like the biggest thing, in Hong Kong, actually. So, but I saw things that shocked me as someone who grew up in a free society. And, I can tell you guys all kinds of horror stories, but you guys know them all. I'll tell one for the sake of the audience. So, for example, I had a friend in Shanghai. We called her Maggie, but she really had no official name. She has no birth certificate, no school records, no hospital records. No, she basically doesn't have Hoku, right? So she was born the second child, and her parents decided to register her brother for school, being the boy. So that's she's one of the lucky ones out of the products of the one-child policy. There's, like I mentioned, 30 million missing women by official estimates, 60 million by other estimates, that are just missing. So not unaccounted for or not registered, but literally missing people. So I realized that the one-child policy did have a huge impact on me, and I'm a product of the one-child policy. And I realized that this completely changed the culture of my generation. Not to mention made China the country with the worst demographics in the world, and still is now. I mean, we saw some ridiculous kind of ideas coming out of some scholars in China saying, oh, well, to solve this, population problem now that we have due to the one-child policy, women should have two husbands, right? I don't know if you guys saw that a couple of days ago.
Oh, yeah.
Yep.
And they would definitely be able to cook for, multiple men and, sexually service them. No problem.
No big deal. Right. So it's getting a little desperate over there, as far as the demographic situation, as you can see. So, policies, I realize policies matter, governance matters, and these things make a huge difference to the future growth and, prosperity of the country and the society as well. So I think that's where the seed was planted, is when I was in Hong Kong. And when I came back to the U.S., I worked for Fidelity as an advisor for about 10 years. I had also clients who wanted to invest in China because it was kind of the hot thing at the time. And I was like, dude, you guys have no idea, what's going on over there. You think, but these companies, have different sets of books. They show different people, right? So what they're showing you is different from what they're showing an accountant or a lawyer or an investor. So it's all completely different. And so there was that. And also I had clients who were similar to me, who wanted exposure to emerging markets, but they came from Russia or Saudi Arabia or, some of these other very unfree countries. And they said, I don't want to invest in my home market because I don't want to support that regime. And I know that when I invest over there, the money doesn't really go to investors. It goes to legitimize the regime and to further help their cause. And so, eventually when I had a child, I decided to stay home with her. And when she got a little bigger, that's when I started this company.
Do you think a lot of Americans would be interested in investing the way you are? Because I imagine a lot of people are invested in China and they don't even know about it.
Yep, that's the problem we're here to solve. So there are a lot of people invested in China in these emerging markets indexes that really don't know. As you can see, most of the people that were invested in Luckin had no idea they were invested in Luckin. So that's through these emerging markets broad emerging markets index funds. So I think the awareness is not quite there yet. A lot of people still don't know that they hold a lot of China exposure in these indexes. And by the way, it's not just China exposure. There's also exposure to Russia, Saudi Arabia, Egypt, and Turkey. Brazil also, but people seem to have less of a problem with Brazil, although we don't have any Brazil exposure either. So it's like 50% of your emerging markets allocation, if you're in one of these index funds, which is supposed to be, neutral, is in these kind of like very autocratic, almost murderous regimes, right? So there is no neutral in emerging markets investing. You're either promoting freedom and supporting freer regimes, or you're supporting autocracies. So in emerging markets, I think it's especially important, especially as we see declines in freedom around the globe, to be aware of how you're investing and know what you're supporting in those allocations.
So what is the kind of conventional wisdom around, investing in these countries like China or Saudi Arabia or Turkey? Like, do fund managers worry about it, or do they say, well, it's not up to us, this is just the way the indexes are run? Is there an awareness that there is like a risk there, or a moral imperative to not invest in autocracies, like you said?
Yeah, so I think a lot of this has to do with the rights of ESG. So we don't hold ourselves out to be ESG because we don't use those company level ESG metrics, which are the standard ESG in the industry.
Sorry, what's ESG?
Environmental, social, and governance standards in investing. So it's kind of like impact investing. So what used to be called socially conscious investing is now called ESG. And so we're really appealing to a similar type of customer. So the investor who believes in the benefits, the long-term benefits of freedom, and wants to allocate accordingly. That's the type of investor that would be interested in our fund, and that is not everyone. There are people who literally don't care. There are people who don't know. So there's the don't know crowd, and there's the don't care crowd that just make me money. So that's very common in Wall Street. And actually, I'm reading a book right now. I just finished by a friend of mine called, his name is Dan Rasmussen. And this book is about the 1811 slave revolt in America. And when he was describing, who decided what side they would be on, the slave side or the slave owner side, some of the slaves decided to be on to side with slave owners and to alarm them and let them know what's going on. Kind of basically just siding with their oppressors because they thought that they had the best chance of winning. So it was like a survival mechanism. And when I read that, I understood all of Wall Street, and I understood why, a lot of, and I've heard someone else say, and I don't think this particular person who said it is the best face of the industry. So I won't credit him with it, but this is not my quote, but someone said, corporate America today is basically the biggest apologist for China, and Wall Street is their investor relations department. So, definitely the consensus, if I had to pick a side on Wall Street, would be to invest more in China. And in fact, right now, and I'm not on a lot of mailing lists. There are companies, ETF companies who exclusively invest in China. I'm not on those mailing lists, but I am on some other lists where I do still get white papers and research pieces that say, the case for increasing exposure to China. Like, I'm in the middle of COVID-19 and they're sending me this stuff. It's completely, it blows my mind, the way that we do these types of investor relations for China through Wall Street. So yeah, definitely it's the consensus.
I think that the argument for investing more in China is that, Chinese companies don't have to adhere to transparency or SEC requirements, so they can make up whatever growth they want, and therefore they can have higher growth. That means more returns.
Makes sense, right?
Until you're the one left holding the bag when the stock drops 75% in a day.
It's almost as if there's a lot of wolves in Wall Street.
Oh, okay.
That's where you were going.
That's where I was going with that. I actually had an intelligent question, but now I forgot.
That's what happens to me when I'm trying to think of like, I got to say this clever thing in like 2 minutes, I'm thinking of it. And then by the time I say it,
it doesn't make any sense anymore.
Yeah. A, it's not clever. And B, I've forgotten the intelligent thing.
That was pretty good.
Thank you. Does anyone else have an intelligent question? Because I've dropped the ball.
Yeah, go, Shelley.
Well, I was going to ask about Luckin specifically. It seems that even if you're not investing in an emerging markets index, now that so many Chinese companies are IPOing here in the US, it seems like it's like they're bringing that here to US stock markets, like the problems with the transparency or like the volatility. I mean, is there any recognition of that risk?
So I think right now is kind of an interesting moment where there is a little bit of recognition of that, surprisingly. So I think COVID-19 highlighted a lot of the issues in China, a lot of the non-disclosure and just hiding information. So, we saw that, with COVID, that there was information that was kept from the world, and it has affected now everyone. So we are less myopic than we were before. I think there's more people looking into, hey, what's going on in China, and realizing, wow, this is how they normally operate. So this is not, out of the ordinary how they handled this crisis. So yeah, with stocks that list in the US, we are exposing ourselves, and we have in the past given them kind of a pass on not adhering to everyone else's standards that everyone else adheres to. And now we're taking steps to correct that. So, all this delisting talk that we're hearing about, we're not picking on China at all. This is literally, we've given them a pass in the past, and I don't know if that was by accident or, by greed. But we're just now saying, okay, you have to follow the rules that everybody else follows and has always followed. And not only that, but you have 3 years to, to start following them. And if not, then you have to delist. And, it's not a big deal. Just go list somewhere else. They won't be able to raise as much money as they can listing in the US, but, it's not the end of the world. So yeah, with our allowing them to be listing on our stock exchanges, we do expose some of our investors to more risk. Absolutely. And I think we are kind of waking up to that a little bit. I heard something the other day that there was like 270 bills right now, bipartisan bills in Congress regarding China, including this kind of delisting bill. So I think it's definitely having a moment, and maybe it's a pivot.
Well, fortunately, that helps me remember my intelligent question I was going to ask. So yeah, with the coronavirus, you see a broad public awareness of sort of the dangers of investing in China. As you mentioned, there's a lot of work happening in the U.S. government now. But do you think this awareness has actually penetrated Wall Street, or are they still going to just steamroll ahead with trying to invest in China? And if that's what they think, what can stop them?
Yeah, so I think Wall Street, along with a lot of the bigger corporations in the U.S. That have been trying to break into the China market, it's going to be very difficult for them to pivot away from that. So I wouldn't count on it. I wouldn't count on for example, iShares is doing a lot of business with China, BlackRock. That's the parent company, and then even Vanguard is partnering up with Ant Financial, and these are two of the biggest players in the ETF world. They hold the majority of the market share, SSGA being the third biggest, and I don't know their relationships with China, but so I doubt they're going to walk away from that at this point. And yeah, a lot of it's not just public equities, which is what I deal in, but there's also private equity, which is by nature a lot less transparent, and I think there's a lot of private equity in China as well. So, and those are the Blackstones of the world. So the KKRs, right? So those guys, I doubt they'll walk away from it. So how do we change that is it's going to have to be a grassroots effort from smaller issuers, which we call the indies affectionately, like us. And, it takes a smaller firm that isn't ingrained in these traditions to be able to do something different. And so that's our role, or how I see it in the marketplace.
That's interesting. It kind of reminds me, my brother, before he got into hedge funds, he had been working at one of the big U.S. trade. I won't mention the company, but he was trying to, this is 2000 and maybe 6 or 7. He's trying to put together a green investment fund. This is before it was cool, but it was California. So we thought, this is interesting. Yeah. A lot of clients actually had an interest in it once he pitched the idea. And then he went to pitch it to his boss. And again, this is one of the biggest U.S. investment companies. And his boss is like, this is not the way we do things. We don't do green investments. Absolutely not. Yeah. And, that was one of the factors that made my brother just leave that company. But it was like, even though you had a really good idea that was financially sound, there was just like no interest from the corporate level because they had a way of doing things and they didn't want to change, even though that there was a market interest in that.
Yeah, that's a common story. I mean, finance is very conservative industry. So it's very, we do things a certain way and we don't deviate from that. So there's not a lot of room for creativity or life and liberty, so to speak.
Well, it makes sense when you are dealing with people's money. You don't want to take wild risks with people's money.
Yeah. Well, unless you want to buy mortgage CDOs.
Right. Oh. That's different podcast. Yeah. I guess this whole idea that China is not risky, or it seems just crazy.
Debt bubble, housing bubble.
Right, but also just like the total lack of transparency. If corporations don't have to meet any transparency requirements for like how they're run, and yet they're publicly listed, like that's insane to me that American investors would be like, well, that's a good idea.
Yeah. No, actually, after Luckin, after the news came out of the scandal, I contacted some of my friends in China. I was like, hey, did you ever try the coffee? Like, was it good? And I was like, why did this one guy take the fall? The COO. Surely there were more people involved. And they sent me this video. I don't know if you guys saw it, but there was this video going around on Weibo of this, analyst. He had it set to some kind of rap music. And he was just talking about Luckin. He was like, yeah, this is the greatest company in the world. They give Chinese people free coffee, and then they go to the US and get the stupid money, and they come back and, give the people more coffee. So this is the greatest company in the world. So really, literally, they were laughing at us. China is laughing at us, the way that we invest in these narratives that they spin in these companies that are completely fraudulent. And Luckin is, as you know, not the only one. A lot of shadier things happen in bigger companies, actually, and the bigger ones are, I would say, even higher risk. And companies like Alibaba, like JD, those types of companies, as an entrepreneur in China, for example, Jack Ma, you're a target. You have a target on your back. Probably going to get a visit at some point, and I think we've seen evidence that Jack Ma already has from party officials saying, "Hey, we need you to prove your patriotism, your love for the country," and by that they mean we want ownership in your company. And you can see Jack Ma, abruptly retiring and saying, hey, I changed my mind. I want to teach. That's what I've always wanted to do. That was just odd. Like there's something shady about that. So, I don't know if you guys remember when that happened, but that was very, very strange situation. And so that's what happens with these Chinese entrepreneurs. And so, and also HNA, another example, right? The chairman of HNA fell off a wall in Provence, right? So he died, fell off a wall.
Look, that's a very normal thing that happens to people.
They stand on walls.
And, gravity is a thing.
And then, who would be kind of the person to investigate that? Like Interpol, right? Then Interpol head disappears.
Who was a Chinese national and disappeared in China.
Yeah. Who was a Chinese, he disappears in China. Yeah. So very strange, so all of these risks, I think investors, but I don't blame them, because as someone who, mostly grew up in the States, I see this type of stuff as very it's like unfathomable to me that this is real, that this stuff happens. It sounds like a novel, or some kind of, really outlandish story. So, but this happens. It's all the time. It's a norm over there. And unless you've had exposure to the country, I don't think it's natural for us to be able to imagine it. So that's why I think American investors, on the whole, historically have not seen the risks coming.
Yeah, I mean, I think one of the interesting things about investing in China is like you have your normal risks, right? Like if you're investing in a company that does, that's, a pork company or something, like, you could be affected by, a disease, or if, it's an agricultural company, you could be affected by weather. And that's the kind of normal risk that investors in this field would take into account, right? But then there's the kind of black swan event type risks, or just like these sort of, out of the blue type of political risks that aren't factored in.
Yeah.
Like, the head of the company is disloyal to the Communist Party. But like that could completely shut down a company, but there isn't really a way to put a number on that level of risk. Like, does that increase the risk by 5% or by 10%? Like how do you even numerically handle that?
Yeah, I don't think you can. I mean, that's a risk that takes you out completely. So
right. But I mean, I guess you've sort of figured out a way to do it without putting a number on those risks themselves, but rather looking at a different set of numbers that can kind of handle numerically those type of risks.
Yeah. So we're looking at the environment in which the company operates, and the risks are based on that environment. So yeah, absolutely.
Well, your index invests heavily in Taiwan.
Mm-hmm.
Do you think Taiwan could be a viable alternative to China?
Absolutely. I mean, they are I don't know if you saw maybe a couple months ago when they were having a lot of success with the coronavirus situation, and Washington Post accidentally titled an article, "The Free China shows us what to do with coronavirus," right? The free China is the cure for the coronavirus. And everybody was like, come on, say the name. Of course, us China hands are going to be like, oh, you have to say the name. But actually, I was thinking the free China is not a bad descriptor, because everybody says, oh, China, is different. China doesn't want to be free. Their people don't want to be free. They're enjoying, prosperity, enough prosperity as it is, they're fine, in this system, and our system may not be better, and so they're questioning whether China can be free, but Taiwan has shown us that it can, and it is all Chinese people, and they all are free, and they're democratically electing their leaders with a voting system that's arguably more reliable than ours, and they have been the shining light for freedom in their region, which is what you see in most of these freer markets, is that they are the kind of leader of the freedom in their region. You saw with the Hong Kong protests from day one, Taiwan was a supporter, and not just in word, but in deed, and in actions. And so, welcoming refugees and so forth. So this is I think Taiwan is a huge indication that Chinese people can be free, and it's proof of that.
I mean, I don't even remember the last time a Taiwanese businessman fell off a wall.
Right? Yeah, their business norms are much closer to that of the U.S. and other free markets.
So you mentioned earlier the TSP and a lot of these pension funds that have some kind of exposure to China. Do we know how many pension funds or retirement funds do have that kind of exposure?
All of them.
All of them?
All of them, yeah, because they have to, by policy, benchmark to MSCI. 90% of pensions benchmark to MSCI, which has, right now, if you look at the MSCI-based ETFs, 38% in China. So 38%. VWO, which doesn't have South Korea as part of emerging markets, has more China. So they have 40 to 41%. That's FTSE indices, and that's more. European pensions may benchmark more to that, but American pensions mostly benchmark to MSCI. There's a video that I have a bone to pick with them. I defended MSCI, in the whole, when Rubio came out and said, MSCI should be considering human rights and things like that, I was like, oh, it's not actually their fault. I actually said this on TV. It's not MSCI's fault. It's just the standard in the industry to market cap weight. But then I saw someone from MSCI get on TV and say, oh, we don't tell people how to invest. We're just indexers. That's BS. Like, indexers set the standard. We tell people how to invest. We set the benchmark. They are the setters of all of the U.S., practically all of the U.S. pensions, foundations, endowments, public and private funds. They're benchmarked to the MSCI, and even their own, so their own funds, even ESG funds, the socially responsible funds, benchmark to the parent index. So for example, the emerging markets ESG fund from iShares, ESGE, has 34% in China. So you don't have, alcohol, tobacco, gambling, porn, but you have 34% in a country that is running concentration camps, no problem. So it's ridiculous. And yes, absolutely, indexers tell people how to invest. We set the standards. You are the benchmark, especially MSCI. And so I regret having defended them, and I disagree with their assertion that they are just indexers and don't tell people how to invest.
Right. I mean, just even the idea that they get to decide that market cap should be the way that they weight it, which is already very arbitrary.
Yeah, that is kind of, it is. But that is the industry standard, so they could technically use that as an excuse, but I think it's an excuse. I think...
Right, but I mean, it's the industry standard, but the industry standard could change if people wanted the standard to change.
I think it's one thing to say, we're using industry standard. Another thing to say, we don't tell people how to invest. That's the part I have a problem with. You do tell people how to invest by setting the standard. So, I think that there's a lot of, we rationalize it in our own minds. But you also have to look at a lot of these Wall Streeters that talk about China very favorably. You have to look at their own business dealings in China. Like, how much business are you doing with China? And is that at risk? Or, how much business are you trying to do with China? I mentioned, for example, Ant Financial and Vanguard, right? So that kind of gives, if somebody from Vanguard is going to talk about China, I'm going to be a little bit wary, right? So iShares, does a lot of business. iShares is the biggest ETF firm here, and they benchmark to MSCI indexes. So that's kind of a partnership there. So you can see iShares, talking very favorably about China as well. So and not only public equities, but private equities. You see Ray Dalio is extremely favorable when talking about China, and he hasn't disclosed his China business. I think we need to be aware of biases that people may hold because of their own business interests.
Well, so for someone listening who wants to invest their money but not into an authoritarian regime like China or Saudi Arabia or Russia, what advice would you give them?
So, that's what we do. So we have a freedom-weighted solution that gives you access to the freer emerging markets. And we actually we don't just exclude the unfree markets, but we actually overweight freer markets. So we reward freedom. So the higher the freedom level, the higher the weight in the index. So that's why we have higher weights in Taiwan, South Korea, Chile, and Poland. Those are the highest freedom emerging markets. And then the kind of middle of the road ones get a lower weight, and the worst actors are eliminated altogether.
So can investors now buy your ETF?
Absolutely. It's trading in real time, available to everyone. It's available to the public. So that's the beauty of ETFs, is that you don't have to be a pension, to have access to it. Everyone has access to it. It trades just like a stock on an exchange. If you want to learn more, you can certainly contact us, and we'll be happy to give you more information. Or you can, just if you have a Robinhood account, you can buy it in there. Any kind of brokerage account. Check with your financial advisor to make sure it's appropriate for your risk profile. But if you are an investor in emerging markets funds, so if you're holding, for example, EM, IEMG, or VWO, and want a freer country set or to balance out your country set, this would be why we created this.
For a lot of people who are, have their money in pensions and things like that, is there anything they can do about it?
If you have your money in a pension, so let's say you're a teacher and your money is in a teacher's retirement, a public pension, the only thing you can do about it is to appeal to the operators of the pension. So you can write or contact your pension administrator. And typically they're like, for example, in Texas here, we have the Texas Teachers Retirement, the TRS, Texas Teachers Retirement System, and you just contact TRS. I don't know what the website is, probably like trs.gov or something, and let them know, hey, I am interested in I think we should divest from some of these markets that are less free, whether it be China or whatever market they have a concern about. China being obviously the biggest elephant in the room. So I would contact your pension administrator. Unfortunately, with a pension, you yourself cannot change that around. But I think it is a fiduciary responsibility of pension administrators to listen to the concerns of their constituency.
All right. Well, thank you so much for joining us today. Why don't you give us the website or your Twitter handle, anywhere people can follow you?
Yeah. So the website is lifeandlibertyindexes.com. And that's the index website. The fund website is freedometfs.com. And my Twitter handle is Perth_Tolle.
All right. With an E at the end of Tolle.
Yes.
All right. Well, thank you again for joining us today. This was exciting.
I feel like this was one of those down the rabbit hole episodes where, when you're like, oh, all pensions are invested in China. Great.
Yeah.
No, that's shocking for most people to hear. But I think for most of your clients, of your listeners, even shocking to hear that they are personally invested in 40% in China in their emerging markets allocation. So, one person at a time is what we're trying to do and trying to notify. And so I think one person making a change makes a huge difference. And, if you have concerns about your pension, you can call and ask. And the question would be, how much, of my emerging markets allocation is exposed directly to China?
And the answer will be about 38%.
Yeah. I was glad to hear that the Trump administration blocked the plan for federal pension funds to be invested in China. That seemed like a bad idea.
Yeah, I mean, that pension plan is actually, that's not even one of the most dire. As I said, they don't even have the overall emerging markets sliver of the pie. Most pension funds do, and have a much bigger allocation. And also pensions, most of them have a public equity side and a private equity side. So, if you have 40% of your emerging markets allocation in public equities in China, you have the same or more on the private equity side. So I think the argument there would be to balance out country exposures. They're never going to completely cut out China, just because that would be them saying, well, we were wrong. And, so I think that's a very unlikely situation. But it does make sense for diversification reasons, regardless of country, to not have that much in any one country. So for diversification, it is a very good idea to balance out those countries' exposures with a portion in something like the freedom-weighted approach.
Well, yeah, it was great. It was great talking to you. If I ever pay off my student loans and get more than $50 in savings, I might might invest. Thank you again for joining us, and
Sure.
Good luck. Wow. Well, after listening to Perth, I'm almost glad I have absolutely no money to my name.
This has made me realize I need to go look at what my IRA is invested in.
Right. Me too. Well, yeah, I hope people watching, this, because the issue is a lot of Americans have no idea they have money in authoritarian regimes.
Yeah.
If they're in a pension.
I remember when we interviewed Robert Spalding, and he said something about how some state pension funds were invested in China to the tune of having investments in the companies that were dredging up the sand for the, artificial islands in the South China Sea.
Yeah. Well, everyone's putting their dollar bill towards World War III. It's nice.
What a beautiful world we live in. we can all work together towards a common goal
Of
total destruction.
Hey, I'm for that.
This got really dark.
Okay,
Yeah.
let's wrap up there before it gets better or worse. I don't know where it goes. Anyways, thank you for listening to China Unscripted. Once again, I'm Chris Chappell.
I'm Shelley Zhang.
And I'm Matt Ganejda.
And we'll talk to you next time.